Before we begin, please support the channel by subscribing, liking, and sharing this explainer. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments.
Market Review, August Macro Catalysts, and Technology Sector Updates.
This explainer presents a direct informational narration of the source document. All right, let's dive right into the chronological market analysis.
Okay, looking at the broader market setup, things started out pretty flat across the four major indices. But as the day went on, we saw this really notable late-day tech stock sell-off. And here's what's actually fascinating, that capital didn't just exit the market to sit in cash. Nope, it rotated straight into Dow component stocks, which shows us a clear defensive shift toward value. At the exact same time, geopolitical tensions flared up in the Strait of Hormuz, with the Islamic Revolutionary Guard Corps announcing they'd be tracking and monitoring foreign vessels. Adding even more pressure, international oil prices bounced back up because the U.S. Strategic Petroleum Reserve just dropped below that critical 300 million barrel mark.
Now all that tension brings us to a very specific intraday event. We had a sudden market dive, and it was entirely triggered by social media posts about mutual compensation demands. Basically, after a statement that Iran demanded compensation for losses from the past 5 months of military conflict, a counter-demand was posted by the former U.S. president, stating the issue would definitely be included in future negotiations. This back-and-forth exchange completely startled the market, causing a sharp, though definitely short-lived intraday drop.
Looking ahead, late August is shaping up to be a massive testing ground for market liquidity. It all kicks off with Wednesday's impending CPI data release, which is a major catalyst that could finally lock in expectations around rate cuts. Right after that, on August 27th, we've got major technology earnings dropping, and then, overlapping from August 27th to the 29th, all eyes are going to be glued to the Jackson Hole Central Bank Symposium. Make no mistake, liquidity could significantly deteriorate as we head into these converging, high-stakes events.
Amidst all of this uncertainty, gold just had a spectacular run, driven by a weakening U.S. dollar, falling yields, and shifting rate cut expectations. Gold shot up approximately 7%. That literally marks its best week since January. And a huge driver behind this, aggressive institutional buying. Just to put that in perspective, the People's Bank of China added 20 tons of gold in July alone, even expanding its storage facilities over in Hong Kong. We also saw Chinese retail investors stepping in as heavy buyers right ahead of the CPI release.
Transitioning over to the semiconductor sector, we're seeing a completely fascinating divergence. Get this, TSMC posted a massive 45% year-over-year revenue growth for July. It's a huge number. Yet despite that undeniably strong fundamental performance, the stock itself remains stuck below its 50-day moving average. It's a perfect illustration of the weird disconnect we're seeing right now between real corporate earnings and technical market momentum.
But TSMC's forward-looking metrics, they are absolutely staggering. The company is projecting a record capital expenditure of $60 billion to $64 billion for the year 2026. On top of that, they're forecasting full-year 2024 revenue growth of greater than 40%. The big takeaway you need to catch here is that TSMC sees zero slowdown in AI chip demand. In fact, they're projecting this insane momentum to continue well into 2027 and beyond.
And this brilliantly illustrates how that incredible demand translates straight into stock performance. If we look at a direct year-to-date comparison, TSMC has seen 38% growth. Now compare that directly against NVIDIA's 17% growth over the exact same period. It really highlights a significant outperformance by TSMC in this specific time frame.
Speaking of NVIDIA, they recently announced a massive strategic partnership with 6 top global financial institutions, including heavy hitters like BlackRock and Blackstone. The goal? To structure a $500 billion AI infrastructure financing plan. This colossal fund is earmarked specifically for AI chip procurement, power generation, and building out data centers. With cash flow tightening among major tech clients, this kind of debt-driven financing is absolutely crucial for accelerating our AI infrastructure. However, that heavy reliance on financing definitely comes with some serious technical concerns. NVIDIA's 5-year credit default swaps, which are basically a measure of debt risk, just experienced their largest 2-week jump of the entire year. And on the technical side, short-term indicators are showing the stock is overbought. Right now, support sits at $215, while resistance is capped between $232 and $236. If that $215 support breaks, the downside risk level points straight down to $200.
Moving on to some other major tech players, Alphabet, or Google, saw a very slight rebound of 0.67%.
Meanwhile, pivoting over to aerospace, SpaceX is currently projecting a massive $20 billion in annual revenue. But despite a real surge in trading volume, the technical levels for SpaceX remain highly defined. We're looking at a strong short-term resistance level at $165 and a projected downside support level sitting at $150.
We also saw some major movement in the eVTOL space, that's electric vertical takeoff and landing. The sector experienced a huge 25% pre-market surge. This was all driven by news of a Boeing transaction where they sold subsidiaries in exchange for equity in an eVTOL company. But as we often see, the subsequent price action was a classic sell the news pullback. It's a stark reminder that high interest rates are continuing to put heavy pressure on these types of future concept stocks.
So, with all this tech growth, what's actually threatening the infrastructure build-out? In a word, local resistance. There has been a rapid escalation in active data center bans across the U.S. It's largely driven by local residents who are super concerned over power consumption, scarce water resources, and noise pollution. Get this, these restrictions jumped from 300 active bans at the end of June to over 500 by early August. Major states are actively joining the pushback and completely removing tax incentives for developers.
And this infrastructure anxiety seems to be spilling right over into the hardware space. We've witnessed a broad, honestly brutal, sell-off in the optical communications sector, with select stocks plummeting by over 16% and 14%. Basically, short-term capital violently retreated to lock in profits. The market had already priced in these multi-year future benefits, which created intense volatility just ahead of major earnings reports from industry leaders like Light and Kuar.
Now, a big part of that optical sell-off is fundamentally driven by hardware design. A major semiconductor architecture shift is currently underway. The industry is moving heavily toward copper and NVLink technologies to scale up cluster sizes. And this shift directly reduces their reliance on standard optical networking chips and traditional memory configurations. It's a massive pivot for the industry.
Yet, over on the memory side, the capital returns remain absolutely immense. According to South Korean media reports, SK hynix is planning a historic $71 billion shareholder return plan. This is being driven by incredibly strong demand for high-bandwidth memory. And what's really notable here is that 40% of this massive total is specifically allocated just for stock buybacks.
But look, despite these incredibly strong fundamentals in certain pockets, the overall short-term market environment remains exceptionally turbulent right now. To describe the violent institutional shakeout happening in sectors like memory chips, our source document leaves us with this vivid analogy. It feels like being thrown into a high-speed washing machine. You cannot open the lid until the cycle finishes. Which brings us to the ultimate question for us as investors. As this washing machine continues to spin, are you positioned to weather the turbulence, or is your portfolio at risk of getting washed out? Let us know what you think in the comments below.